What's up, you guys? Tesla's down another 1.5% today, closing at 208.80. And as we go into earnings coming up, I want to talk about some analyst estimates. What are going to be some things that are going to move the stock either up or down? After earnings, we're going to talk about guidance. And I want to go over a specific option strategy that I like to use during earnings season, because the first thing I would say is, honestly, for your average trader and for most people, unless you're just a long-term investor in that stock, I really wouldn't touch earnings. But I know that a lot of people will go ahead and do it anyway. For me, I would rather actually teach you how I think this is the safest way for you guys to be trading options when you go into earnings, because there's a lot of things like implied volatility, which can absolutely kill your position. And we're going to touch on those in this video. And it's also important for you long-term investors, because one thing you might not understand is that you can actually use options to your benefit, not in a very risky manner like you think you probably see people doing on the internet. But if you're a long-term investor and you're strategic and you understand how to use these financial tools, you can use them to actually not only leverage for bigger returns, but to even safeguard yourself during times of volatility. So I plan to talk a lot more on that going into this video, and definitely more into the rest of this year. So let's start first with Tesla price action. Let's look at this chart right now. It's gonna be the daily chart, and you guys are gonna see that obviously after this sell-off of 240, we broke underneath this support level, and since then we have been swept all the way down to $208. There is a liquidity level here at about 200 to 196, and as the video we talked about last week, we said that there's probably a chance that we'll see Tesla continue to pull its way down, maybe into this liquidity zone, into earnings. Now, if earnings is good, the next level that we're gonna be watching to the upside is going to be up at $235 to $240. This was an order block that was sitting here back on Monday, the 8th of January, 2024. And we see this type of sell-off. There are a lot of people who wanted to get in short, big institutions between 240 and 235. And the reason that this is a strong order block is that once this was swept into this lower low, not once did it ever pull back into this block to test. So that means that there is still a high chance that we should see a bounce around here. Now, it doesn't have to be right at 200, but a test of some sort back up of $240. Now, the reason for that is because all of these limit orders are going to be sitting here. And like we say, we cannot move the market ourselves. So we need to see big buyers and big sellers step in to move the market for us. So 240 will be a very strong resistance level if we see the snap back up to that level after earnings, which is obviously going to be the catalyst here. From there, once this level is taken out, i.e. if it is taken out, we will be watching for the move back up to $260, which is where we have another bearish order block, this time sitting here with a bearish liquidity zone between $264 and $263. Now, the indicator you see on the screen will be a private indicator for our Discord community members, which the link will be in the description, but you can use any type of order blocks like a Lux Algo one that's free on TradingView, or you can learn to draw them out on your own, which is what I like to do. Now, while Tesla is oversold going into earnings, it's not anywhere near where we saw last time back in November, which is why we were saying that there is still the chance, if you think you're buying the dip, that the dip might continue to dip. And you can see that if 200 is broken, the next level that we will have is back down at 184 and 164. Now let's talk about actual analyst estimates and what we are expecting as far as earnings. So the fiscal period is obviously going to be December 24th, and the EPS, or earnings per share, is going to be $4.48. For those of you who do not know what EPS is, basically if there's a number here, it's going to mean that the company is at least profitable. If you're ever analyzing a company fundamentally and there is no EPS, it's usually going to be because the company does not make money. In this instance right now, Tesla does make money, and it's making $4.48 profit per share. So of course, if you want to see a company grow, we're going to want to see that number increase year over year, which means that revenue estimates would be at about $124.28 billion. So if you're investing in any company, guys, we want to see revenue grow. And not only that, we want to see net revenue grow, because if a company is growing top line, which just means gross revenue, let's say that my Discord community where I sell my bots or sell my alert bots, if that company is growing month over month, that's great. That's what you want to see. But if the company is burning profits in order to do so at an aggressive level, that might not be a good sign. So what we really want to see is top line growth, which is just going to be overall revenue or gross revenue. And then we want to see net or bottom line growth. And here you're going to see December 2024, we're looking for $4.48 EPS, which would be a growth year over year, which is YOY. And if you saw MOM, that's month over month, that would be 32% growth year over year. It's pretty good. And you can see that going out into 2025, 2026, 2027, this is how the company is poised to growth. Now, something that you might instantly say is, well, wait, how is the company expected to grow less and less year over year? And the reasoning for that is that as a company grows, it is going to grow less in percentage, usually year over year, if you're going to get into those higher revenues. So for a company like Apple to grow at a 5, 6, 7% growth rate year over year after how long they've been around, the market cap cap, the amount of money that the company does in revenue, to grow that, like you couldn't grow that 40, 50% year over year. But if your revenue is only maybe 5 million, 10 million, 20 million a year, to double that is not that crazy. That's what you want to see as a business owner, but it's not as insane as like Apple would never be able to double their revenue in a year. Which, coming down, as we said, revenue estimates, this number is of course going to continue to go up. So revenue estimates year over year, 23%, 23%, 16, 20, and 2024, and 20% as we go into December 2028. Now, from a quarterly basis, we're going to be seeing 86 estimate, so an EPS of 86, and a year over year growth of 14%. And as we say a lot here on this channel, that obviously guidance is going to be something that's going to be very important. Last time we had earnings for Tesla, you guys remember that we ended up having this massive sell-off, basically where we dropped from 240 all the way down to 196. And honestly, earnings weren't that bad. I really think that it was just Elon Musk and just the way that he presented himself to shareholders after hours on that earnings call was not good. And I don't know, and I'm not going to comment on how or if he's even going to be on this earnings call. I have no idea, or how he's going to perform, but that is always something that you have to take into account. Now let's talk about how we could actually play this out. We're going to be using Robinhood here. I do not use Robinhood, but for teaching this, it's just one of the best platforms from a user interface standpoint. We're buying a call or a put is we are saying that we believe a stock will go up by a certain date and a certain time, and we have the option but not the right, which is very important, to execute our contract for shares, etc. Now, there's always going to be people on the other side of these trades. This could be a market maker, this could be a bank who's writing these contracts, this could be somebody like myself. A lot of hedge funds use this strategy, and even if you run your own family wealth management company or you're just a retail trader of size, you might want to use this bringing in consistent monthly income, which is going to be selling cash secured puts. Now, I understand before we get too far in this that most people here just won't have enough capital to go ahead and sell cash secured puts. But we're going to talk a little bit about how you can actually get around that and trade credit spreads. So as an example, very basically, we're going to come in here and we're going to hit sell on Tesla, and we're going to go to puts. Now, as we said before, normally if we're using puts, we are bearish. And the reason is we are buying the put. So when we are buying this put, we are bearish. Now that means inherently that the person who's selling us this option is going to be on the other end of this bet or the other end of this contract. So it is in the interest of the seller of this bearish position or this bearish contract for the stock to go up. So if we are selling a put, which you can see right now, we are bullish on Tesla. Now, what does this actually mean? Well, in this case, what we would want to do is actually go over to the chart, or fundamentally, you can decide, but you'll want to find a strike price that you believe Tesla or whatever stock you're trading on will not close below by your specific date. So let's say that I don't think Tesla's going to close below $200 this Friday. What I could do is go over to Robinhood or whatever your broker is, hit sell put, and we can scroll to this Friday, which is 4 days from now, and we can isolate this $200 options contract. Now, the first thing you're going to notice here is the strike price, which is $200. This is important because we do not want Tesla to close below this price level, which is why we're picking it. We don't think it's going to close below 200. Now, the chance of profit is 74%. So if you just remove the fact that there's earnings, you remove the fact of any technical analysis, any fundamental analysis, from just a statistical probability standpoint, there is a 74% chance of Tesla closing above $200 by this Friday because it's already above it. Now, some other quick things for you just to notice is that the theta decay is going to be right here at 0.8499. This is going to be important because as we sell this contract, the person who purchases this, just like you and me, as we normally purchase options, they are going to have to pay us theta decay, meaning that the longer that they hold on to the option, especially closer to the expiration, the more money that we will just inherently siphon from them, even if Tesla sits sideways. And then the last thing that we really want to see is going to be volume. And volume is very high, and this is because we want liquidity. It doesn't matter how much money our broker says that we are up or down if we cannot sell it. So if we come in here, you're going to see on the right that we have the $200 put. This is going to be expiring this Friday, and you're going to see the total credit is $3.75. All options are going to be times 100. So the actual max profit, which you'll see over here, is $375, and we're going to have a max loss of $19,625. Sounds really good, right? Now listen, I'm just kidding. There's no way you're going to lose $19,625 unless Tesla, the company, actually went to zero. So now that we've set this trade up, what is the downside implication here? What is actually going to happen if Tesla closes below $200 on Friday? Well, we are not going to to have the option, we will be forced to purchase 100 shares of Tesla at $200, meaning, hey, we're going to spend $20,000 buying Tesla shares. Well, if you want to own Tesla shares at $200, that's awesome. In the meantime, no matter what happens, and this is what's really cool, no matter if Tesla shits the bed, if Tesla rips, if Tesla goes to 500, we will make $375 as long as Tesla does not close below 200 by this Friday. So $375 no matter what. And if it closes below on $200 on Friday, we still keep the $375, but then we're assigned 100 shares of Tesla, and we could hold them forever. We could, hold them till they come back up to 240. You could do whatever you want with them. But the point is, this is a very good way to consistently make a couple hundred to a couple $1,000s per week. Now, in order to do this, though, you're going to need to allocate $20,000 worth of cash sitting in your broker, because they need to actually secure your payment before you can sell the contracts each and every single week. But there's actually a way around this. So now that we have the $200 put, you can see it's sitting up here in the dock, and we're currently building out this position. And you can see that what we're also going to do now, so that we don't have to put all the money up for that, is we're going to get an insurance policy against this. What we're going to do is actually buy a put. While we have this one already selected, we're going to hit buy and we're going to click puts. And what we're going to do is actually put the put, the contract directly below the $200 put that we sold, which means we're going to be selling a $200 put, which is bullish, right? We just went over that, but we are also going to be buying a 197.50 put. This is bearish. Basically, we are still overwhelmingly bullish here selling this $200 put, but the fact that we put this insurance policy in place means that we will not have to put up all of that capital. Look at how it has restructured our position. Now our max profit is $76 and our max loss is $174. And remember, statistically, without technicals, without fundamentals, we have a 75% chance of this being right. Now add into this your edge, and this becomes a phenomenal strategy. Now there is one big downside to this, and this is called this now is called a put credit spread. And it's a credit spread because we're running two options in one. So as long as Tesla closes above 200 by this Friday, we would end up making this profit. Now here's the cool thing. If Tesla goes up, we're going to make $76. If Tesla just sits sideways and does nothing, but just closes Friday above 200, we're going to make our entire profit of $76. If Tesla shits the bed to 160 and completely recovers back up to 200, we will make our $76. But here's the downside. If Tesla closes even a penny below $200, we will lose all of the money that we had to put up, which is $174. Learning how to do this properly, learning how to run proper risk management, learning how to build a risk profile for yourself is so important when you're writing credit spreads. But what I've realized is for a lot of people, this is a great way to grow your net worth and to bring some consistent income into your trading. You just have to learn how to do it right. And if you want to learn how to do it right, go check the second link in the description to join our private academy and our Discord community. Now, let's go over one last aspect of this and why I brought this up in this video in the first place. And the fact is that this is great to run into earnings because we don't just have to have the stock go up, right? If we get calls on something like this, and now if I was going to do earnings personally, I would not be running something farther out of the money. Instead, what I would be looking to do is instead of selling a $200 put, because let's be honest, Tesla's not going to sit sideways after earnings. Tesla's either going to absolutely rip to like 230, 240, 250, or it's going to crater. So I don't really give a shit about going and being safer. Normally, I would want to play it safe, but because I know that there's this massive catalyst that's going to happen, I don't care about going safe. So instead of going with $200, I'll actually go with 208 or even 210. We'll just say 207.50 just to be a little safe. Now, our chance of profit goes from 75% to 65%, but still, like we said, this is a bit of a gamble and we're going to treat it that way from a risk standpoint. Now we're going to come in, we're going to buy the cash secured put or buy the put, and then we're going to come in here as well and simultaneously buy the 205 put, which is directly below it. And you can see here now our RVR is still a lot better than it was before. Now we have a max profit of 108 or 142. The more aggressive that you get, the bigger your risk versus reward will be, but the lower chance of profit you'll have. Let's say you're extremely bullish and you want to be a little gambly with this, which I'm not saying you should. If you really think that Tesla is going to close this Friday over 230, instead of just buying a call and evaporating your money in theta in something that's going to expire in a couple of days, you can sell a 230 put, buy a 227.50, and you will make $223 and only risk $27. Now, of course, your chance of profit here, guys, is like 50-50, but look at how insane that RVR is. You can lose 7 times and still break even. Now, personally, I'm not going to do this. I'm not going to be going out to like 227, 230, but this is all dependent upon you and your risk tolerance. So I hope that this video helped, guys. If you want to learn more, go check out our Discord community. As I said, thank you for all of your support, and I'll see you next time.